So that jobs report we got today, it didn't just miss expectations, it practically forced the Fed's hand. With only 22,000 jobs created in the month of August, the odds of a September rate cut are now at 100%. The only question left is whether the Fed will go small with a 0.25% cut or shock the markets with something much bigger. We'll talk about all of that today. Let's start off with our stock market recap. So today we've seen stocks really fall and bonds rally on the news we got today. The S&P 500 dipped 0.32%, the Dow shed 0.48%, the Nasdaq virtually flat but still in the red territory, down 0.03%. Bitcoin also had a down day, down 0.74%. The main winners we've seen today lied in those treasuries and those bonds, with TLT, that bottom right chart right there, really had a tear of a day, up 1.52%. Energies and financials led losses, falling 2% and 1.8% respectively. Still this week though, the S&P rose 0.3%. We've seen the Nasdaq still gained 1.1%, showing how resilient stocks have been even as the labor market is showing cracks and beginning to somewhat weaken as far as what the data is posing to show. Now let's get into this jobs report. So the August jobs report was really a shocker. Nobody was expecting this unless you were Trump, who said he's not really looking at these numbers. He's looking more of a year out because that's when we're really going to see the real numbers. But what we've seen is that there were only 22,000 jobs added. So that was far below the forecast of the 75,000 jobs everybody was expecting to see. Well, that was the forecast, but nobody thought we were going to go that high. There were some leading tales that gave evidence that probably wasn't going to be the case, but that marks the weakest month for job creation since December of 2020. Then the revisions made it worse. We seen June's data was slashed to show a net loss of 13,000 jobs, so a negative 13,000 jobs there. The unemployment rate ticked up to 4.3%, which is up from 4.2%. Youth unemployment surged, so workers between the age ranges of 20 to 24 now face a 9.2% jobless rate. So if you're graduating college right now and got all your college tuition and loans you got to pay for, good luck finding a job too. I wish you luck. Older workers also saw a rise, so unemployment among those aged 75 and older climbed to 4.2%, up from 3.3%. And so far in 2025, the U.S. has added just 598,000 jobs, which is the weakest pace since 2009 if you exclude 2020. Then let's break down the sectors we've seen. So primarily the two industries that were named that seen the largest growth in this payrolls report were healthcare and restaurants. So mainly healthcare and social assistance were the main primary drivers, which added 46,800 jobs, about essentially carrying the entire number. Manufacturing lost 12,000 jobs, construction down 7,000, professional services off 17,000, federal government employment dropped around 15,000, which not yet reflecting those sweeping cuts announced by the Trump administration. One analyst put it very bluntly that if America wasn't getting older and sicker, we would have had negative payrolls this month. So really, bonds were yipping about this. They were really throwing a party and rallying. So treasuries really rallied on this report that we got today. And we've seen that the 2-year treasury yield tumbled to 3.509%, which was down more than 11 or 12, actually 13 basis points from where we were at the start of the day. The 10-year treasury yield fell to 4.076%, which was the lowest since April. And why these yields matter is because when the yields fall, the bonds increase in value, so there's some capital gain there. But yields are what borrowing costs of loans, so interest rates follow. So when treasury yields fall, essentially in a way, so do interest rates on loans. But bond traders were already positioning for some type of softness to happen at some point, with yields dropping for 2 straight days ahead of this report that we got today. The bond market is now signaling clear expectations the Fed is going to cut rates. It's just a matter of how much, which let's check it out. So, according to the CME Fed Watch tool at that September 17th meeting, there's now a 100% chance of a September 17th rate cut from the FOMC meeting. And yeah, you see these numbers right here. It's a little vague when I say 100%. So 92% of a 0.25% cut, or a 0.5% cut of 8%. So you don't even see, there's not even a spot for them to keep the current target rate of that 4.25 to 4.5%. It's all them cutting rates at that meeting. So that's where we're sitting at right now. So this jobs data really solidified the case for easing. But as one strategist noted, when you're rooting for weaker data to justify cuts, it's a fine line. Sometimes it's a case of careful what you wish for, because you might get it. And that's exactly what we got today. Now, looking ahead next week, we got a lot of data to still go into. So let me scroll up and get into it. We got anything from the inflation data to confidence data we'll be getting. So on Monday, we'll get consumer credit data that will be for July. On the Tuesday, September 9th day, we'll get the NFIB Small Business Optimism Index. This will be for August. Wednesday, mark your calendar for that, because we will get PPI, the Producer Price Index, plus wholesale trade and inventories, also a 10-year Treasury auction. So really mark your calendars for that. Then Thursday, I'd highlight, capital, underline, circle. Thursday is a important day because we're getting CPI, the Consumer Price Index, for August. We'll also get weekly jobless claims. We'll get wage data. Also a 30-year Treasury auction. And then on Friday, it doesn't end. We got a busy week because we got the University of Michigan consumer sentiment coming out, and then inflation expectations. So each of these reports will feed directly into the Fed's expectations for September and beyond. And I'd imagine it'll somewhat move how these numbers rest. But essentially, we're getting a cut. It's just a matter of how much are we going to get. And it's looking very likely that we're going to get this 0.25% cut, or 25 basis points down on the Fed funds overnight rate. So Friday's weak jobs report may have sealed the deal for a September rate cut, but it's also raised this critical question that we now must ask ourselves. Is the Fed cutting to support growth, or are they cutting because the economy is sliding into something worse? Bond markets are betting the slowdown is real. Stocks, meanwhile, are trying to hold on to record highs. September is off to a volatile start with so many catalysts in the pipeline. Investors are in for a defining month, and all we could really do, y'all, is witness everything going on together. Just join me back as I'm reading off and covering what news we got for the day, and I'm happy to do that. I'll be back. Hope your weekend is great. I hope your night is great. Stay safe, everybody, and I'll see you later.